Hi everyone, welcome back to the Property Finance Podcast, and today we're carrying on our kind of AI interview series that we've done, kind of almost a little mini-series. And for today's one, I wanted to do something a little bit different because we kind of always focus on bridging, we always focus on development. And I thought, you know what, let's change the focus a little bit. Let's focus on HMOs because it's something that comes up a lot. It's something that I think a lot of clients have a lot of questions about. And so went to ChatGPT, as everyone does, and basically asked the question of, acting as an HMO investor, what questions would you ask your broker? So it spit out a series of questions, which I think would be really good to go through because reading through the questions, not only are they, again, very surprising in terms of accuracy, but they are questions that we get asked on a regular basis. So whether it be networking events, whether it be just in general client calls, whatever it may be. I think these are really handy, and these little podcasts, these little Q&As, hopefully people are finding helpful. All the feedback we've had has been pretty positive. So yeah, keep the feedback coming. Keep letting me know what you think of these, and hopefully these little Q&As are pretty helpful. So in terms of questions, so the first one is, how much experience do you have arranging mortgages specifically for HMOs? Quite a lot. Is the answer to that one. So we do a huge amount of HMO mortgages, whether it be small HMOs, large HMOs, whether it be people converting offices into HMOs, whether it be small 2-bed houses into 4-bed HMOs. We've kind of covered all facets of HMOs. So all the way from kind of the acquisition finance, so refurb finance, all the way through to arranging either commercial mortgages or bricks and mortar mortgages if, for example, they're smaller HMOs. And then the next question is, how many lenders do you have access to that cater to HMO investors? So this is kind of open-ended, this question, because it could be refurb, it could be development, it could be commercial mortgages, it could be bricks and mortar mortgages. So there's kind of any number, but I would say on average, we probably have, in terms of HMO mortgages, we've probably got 20 lenders, I would think, at the minute, covering a whole range of experiences. There's probably more than that, come to think of it, but we'll say 20 that we use on a regular basis. In terms of refurb loans, we've probably got access to, again, probably 20 or 30 different lenders as well. So there's quite a few on there as well. The next one, are you independent or are you tied to a specific panel of lenders? We are completely independent. So we have no network, we have nothing like that whatsoever. So we approach lenders directly. We don't approach through any third parties or anything like that. We go straight to the lender, straight to the decision maker. So we don't have anyone else. Some other brokers have networks that they have to go through. So they'll have to take your case, give it to essentially another broker for them then to put it through. So we are direct to the lenders. And then the next one is, what are the current trends in HMO lending rates and criteria? So at the point of recording this, we're seeing decreasing interest rates. In terms of the criteria, we've seen a bit of a tighten up in terms of experience. So if you're looking at doing larger HMOs, for example, so I would class a larger HMO as anything kind of 6-bed plus. Some define it as 7-bed plus. I personally would put it as 6-bed plus. Anything 6-bed plus, we're seeing more stringent experience requirements. So lenders are really pushing for a good level of experience, so kind of having owned HMOs previously, maybe having a decent sized portfolio previously as well, normally kind of 12 months experience on those. Anything 5-bed or less, we're kind of able to get through via exception. So if you're a first time investor, for example, we have lenders who are happy kind of lending on those smaller HMOs as a first time kind of investment property. So in terms of criteria, yeah, we're seeing a bit of a tightening up and rates coming down as well. Then the next one is, do you foresee any regulatory or market changes that might affect HMO mortgages? Personally, at the minute, no. I think the stamp duty changes won't have a massive effect. I can't really see, there's been a huge amount of changes over the past few years to HMOs. I think they're probably pretty much done for now, at least in the short term with HMOs. Their focus very much seems to be on holiday lets and service accommodation at the minute. So I think I can't really foresee anything from a regulatory perspective. In terms of market changes, it's really difficult without a crystal ball to know what's coming. At the point of recording this, Trump's in power, obviously making changes. Labour are still doing Labour things. So it's really difficult to know what's coming up. But I think in terms of kind of the market change we're seeing, I think we will see more of an availability of HMOs, which may, because obviously landlords are moving into HMOs potentially to increase the yield that they're getting from their properties, because Obviously, when interest rates were up, they were obviously taking far less in terms of profit. So we may see more of a shift to landlords moving into HMOs, which may create an abundance of rooms. We may see room rates come down. It's really difficult to know. I hate that question because I don't have a crystal ball. But personally, I don't foresee a huge amount coming up. The next question, are there any specific restrictions on the property size, number of bedrooms, or tenant types that lenders impose? No. The only restriction that I would say on tenant types is that you're probably looking, lenders prefer white collar, blue collar workers. They're not looking for almost the supported living type tenants. I think that's a different product. So I think HMO tenants, they've got to be in that kind of white collar, blue collar state, really. I don't see them allowing anything else. In terms of number of bedrooms, 2 to 5 is kind of where you're looking at for your first time investors. 7 plus, I think, for your more experienced. I've not found an upper limit in terms of room numbers yet. I would ask anyone to challenge that. I think it'd be a good little challenge to have. But we've not seen any as of yet. Property size, again, I've not seen any specific requirements around that either. So we've got lenders who will cater, like I said, anywhere from 2 bedrooms up to 200-300 rooms. In terms of the next question, are there specific lenders for properties with more than 6 or 7 occupants, i.e. a large HMO? Yes, absolutely. So there are lenders who will specialise in 2 to 5, and then there are lenders who will specialise in 6, 7 plus. So they are your more commercially minded lenders. And that brings us nicely on to the next question, which is, will the lender use a bricks and mortar valuation or a commercial/investment valuation? As you see, a lot of these AI questions, I think, are literally questions that we get asked on a daily basis. They are questions that come up on every single networking event that I've ever been to. I've genuinely been really impressed with some of these questions that have come up with. In terms of whether a lender will use bricks and mortar or commercial, purely comes down to opinion to a degree. However, as a rule of thumb, 2 to 5 bedrooms, I would say, is always going to be bricks and mortar. 7 bedrooms plus should always be commercial, because at 7 rooms, you're talking about being on C4 planning use. So it's always going to be a commercial valuation at that point. If you are in an Article 4 area, again, always going to be a commercial valuation. 6 rooms is that weird in between. And there are a couple of lenders who will refer to it as a hybrid valuation. So it's almost like a bricks and mortar with a bit of an uplift to accommodate for kind of the money that's been spent. But I would say as a rule of thumb, 2 to 5 bricks and mortar, 7 plus commercial, 6 is a hybrid. Article 4 is always going to be a commercial valuation as well. Then the next question is, how will the valuation impact the loan to value? It won't. So the valuation has no bearing on the loan to value. The loan to value is always going to be, if you want to go to the high leverage, it's always going to be 70-75%. The valuation will just obviously impact how much you can borrow, because it will be 75% of that valuation. In terms of whether you have a commercial or bricks and mortar, what we tend to find is it doesn't really affect the loan to value. So lenders who do bricks and mortar valuations will go up to 75-80% potentially. Lenders who do commercial valuations tend to go up to 70-75%. So it doesn't have a huge impact. Then the next question is, do lenders require proof of HMO licensing before offering a mortgage? It really depends on the lender. As a rule of thumb, normally they'll want to see at least proof that it's been submitted for. So a license has been submitted. Now, there's obviously delays normally with the council issuing those licenses. So I think as long as they can see it's been submitted, most lenders will be happy offering, and will then go through the legal process and will then want to see the license before drawdown. But we have had some instances where, as long as the council have got some sort of back and forth with you saying, yeah, a license will be issued with no issue, then some lenders may take that and allow drawdown without that. And then the next one is, what happens if I am converting a single dwelling into an HMO? Will lenders require a specific conversion license? I think this is where AI shows it doesn't quite know everything. So this is referring more to a sort of permitted development or planning. So when you're going through, obviously converting single dwelling into an HMO, obviously check with planning consultant whether you need to go for permitted development, whether you need C4 planning. Depends whether you're in an Article 4 area, for example. So just check with your local planning consultant, and obviously they'll be able to give you guidance as to whether or not you need that. But obviously the lenders are going to need that depending on the feedback that you get. Then the next question is, if I purchase the property in its current state and convert it to an HMO, can I refinance quickly to release equity? Yes and no. So yes, you can refinance to release equity. Whether you can refinance quickly or not is a completely different matter. So what I would say as a rule of thumb is expect to be on your bridge or your refurb loan for minimum 6 months, because most lenders like to see some sort of ownership for at least 6 months before they then refinance. So there's not going to be a really quick refinance happening. I mean, most refinances take 3 or 4 months anyway at the moment, with sort of legal delays and everything else. So I would say realistically allow 6 months. I think that's probably where you want to be. But in terms of releasing equity, absolutely. And then it's asked as a follow-up, are there any specific products for this strategy? Well, if you wanted to release equity quickly, I would look at going onto a refurb loan and lining up the refinance at the same point that you take the refurb loan. It's as simple as that. There used to be a bridge to let. There are still lenders that kind of do bridge to let, but the whole benefit of bridge to let was that you would bridge, do the refurb, and then refinance immediately, but you would do it without any fees. Now it's a case of bridge, refurb, refinance with the same lender, but you're paying fees at every stage. So it doesn't really have the same benefit that it used to have. Then the next question is, what is the maximum loan to value for HMO mortgages? Kind of already touched on this, but I would say about 75% at the moment. And then the follow-up to that is, are there significant rate differences between higher and lower loan to value products? Not significant. I would say there is a bit of a difference, but not enough to, if you were looking at a 75% product and a 65% product, you would very rarely see any kind of difference. Where you see the difference is if you're looking at a 75 and a 50%, and that's where you would see kind of a dramatic drop. But even then, I would say you're probably only talking a quarter of a percent to a 0.5%. It's nothing earth-shatteringly different. And then it's asked, what are the typical interest rates for HMO mortgages? Again, this is a tricky one because at the point of recording, you're looking at kind of late 4s, early 5s. However, they've been as high as mid 6s. I think in terms of if you're going for bricks and mortar, I would budget anywhere from 4.8 to 5.3. If you are going for a commercial, I would budget anywhere between 5.8 and 6.3. That's kind of where I would budget. So for your larger HMOs, you're talking early 6s. And then the next question is, are there fixed rate or tracker products more suitable for HMO investments? I think what this is really asking is, what's the more suitable? Is it a fixed rate or a tracker? I would say it really does depend on your own risk appetite. There aren't many tracker products for HMOs at the moment, but I would say personally, from what I've seen recently, fixed rate seems to be kind of a safer move for most people. However, it depends on what you believe is going to happen in the market. I mean, we seem to be on a downward trend at the moment, so it may be that a tracker is more beneficial for you, but I would weigh up kind of the pros and cons. Most trackers tend to be more expensive, obviously, than fixed rates. So I would have a look and maybe go on a 2-year. We've just run a 2-year versus 5-year model at the point of recording this, and we found that comfortably the 5-year at the moment was significantly cheaper if rates stayed similar for the next kind of 5 years. Obviously, whether that's going to happen or not, who knows? Very unlikely it would, but running that as a parallel, that's with the 2-year having to refinance 2 years later down the line and then another year. So we've built in kind of 2.5 lots of refinancing and all the fees and everything else, and it still works out that the 5-year was cheaper. But obviously that's based on the point of recording at the moment. Then the next one is, how do lenders stress test rental income for HMO properties? Exactly the same as they stress test it for any buy-to-lets or anything like that. They do debt service coverage ratio of 125% for a limited company and 145% for personal. So what you do is you work out what your interest is per annum. So you literally just take your interest rate and do it against your mortgage amount, and then you times that by 125%, and that's the amount that you've got to try and bring in. What lenders may do is they may build in a void period on HMOs. So they may look at it and say, right, okay, based on this HMO being 80% let, what is the amount that's going to be brought in, and stress test it against that. But recently, to be honest, we've just found lenders stress testing it as they do any other buy-to-let. And then the next question, literally I've just answered, are there specific income multiples or rental coverage ratios I need to meet? 125% for limited companies, 145% for personal. Moving into a bit more around the criteria. So It's asked, do lenders require prior landlord or HMO management experience? If you're going on the larger HMO side, I would say yes. For smaller, I would say probably not. So 5 bedrooms or less, you can probably get away with it. I would say HMO management experience is ideal. If you've got that or you can get that, it really does help, obviously push the application through, and obviously prior landlord experience helps as well. And then it's asked, what are the criteria for first-time HMO investors? So again, 5 beds or less, I think is the key one. And you've got to have realistically a minimum income of 25 grand. I think if you've gone through the purchase and the refurb element, so you've bought it and refurbed it, that really does help when going for an application for an HMO mortgage, because actually going through that development process is sometimes trickier than actually going through the rental process. So we tend to find that helps, obviously, the application. And then, should I purchase a property personally or through a limited company? I really can't answer that. I would direct you to an accountant. It's not that I can direct AI to an accountant, but you know what I mean. I would speak to an accountant and understand your own tax position. We see 99.9% of our clients go through a limited company now. Are there specific lenders or products available for limited company HMO mortgages? Yes. So there are lenders who will deal with both limited company and personal name. There are some lenders who will only deal with limited company, but I would say the rates are pretty much the same for both. And then the next question is, how does my credit score affect my mortgage options for HMOs? Not as much as you would think. So HMO lenders tend to be a little bit more commercial, a little bit more pragmatic. So your credit score doesn't really come into it as much. Obviously, your credit score is going to have an effect. I would say if you've got lots of missed payments, low credit score, CCJs, bankruptcies, all that kind of thing, you're really going to struggle. I think at that point, you would probably move on to a more specialist product, so almost like a hybrid bridge mortgage product, just to get yourself to a point where your credit's maybe a bit more suitable to go through some of the mainstream lenders. But we, touch wood, as of the point of recording, haven't had a client that we haven't been able to finance yet. So credit score hasn't affected many of the clients that we've got. And then the follow-up question is, are there lenders who cater to borrowers with less than perfect credit? And there are lenders who will deal with less than perfect. If you start getting into bad, that's where we mentioned about obviously the hybrid product, and that really does come in helpful for clients who have had maybe bankruptcies, insolvency, CCJs. It just allows them that time period to get themselves back to where they want to be. In terms of cost and fees, it's asked, what are the arrangement fees, valuation fees, and other costs I need to consider? So arrangement fees vary lender to lender. At the moment, we're seeing anywhere between 2 and 5%, depending on what you're doing. Valuation fees, again, anywhere from kind of 750 up to 2, 3, 4 grand, depending on the size of the HMO. You may also have application fees as well. So some lenders charge like a £300 application fee. So it's worth keeping an eye on that as well. And then it's asked, can you add fees to the loan? Yes, you can. Most lenders will allow those arrangement fees to be added onto the loan. Some may cap to 77% loan to value, for example. So if the arrangement fee is 3%, what you might find is that actually you only get 74% day one because they've had to add the 3% fees on. And then it said, are there any early repayment charges or restrictions on overpayments? So most lenders will charge ERCs, so early repayment charges. They can range from anywhere from 5 to 1%, depending on how long you've got left. Most lenders will allow 10% overpayment without incurring any charges or fees. So it's well worth keeping that in mind as well. And then as a follow-up, it's asked, what happens if I want to sell or refinance within a few years? Depending on what the early repayment charges are, I would say you've got that kind of weigh up that cost. So if you're on a 5-year fixed, obviously you're going to experience those early repayment charges for slightly longer, for the 5 years. So they will probably go on a sliding scale of 5, 4, 3, 2, 1, depending on how many years you've got left. So it's worth thinking, if you are going to sell the property, if you've kind of got it in the back of your mind of, right, I want to run this for 2 or 3 years and then I want to sell it, it may be more beneficial to go on a 2-year fix. But again, without a crystal ball, it's really difficult to know what you're going to want to do with the property moving forward. Then it says, are there any additional costs like lender insurance or conditions for maintaining the mortgage? So this is asking about ongoing costs. Obviously, you need to deal with the insurance. The lender needs to be noted on the insurance. There are no ongoing costs for the lender, but in terms of maintaining kind of the mortgage and everything else, you're not really going to experience any of that unless you're refinancing or potentially doing some sort of capital raise, for example. So if you're doing a capital raise, again, you may incur some fees for that. Next question is, how long does the process typically take from application to completion? I would say probably between 2 or 3 months at the moment, with sort of legals and everything else. It really isn't the quickest process. Actually, ironically enough, the follow-up question is, are there any fast-track options if needed? There aren't specific fast-track options, but if you have a specific deadline to hit, there are lenders who are going to be quicker than others, albeit they're probably going to be the more expensive ones. And in terms of kind of legals and everything else, there are certain things you do, like making sure that your solicitor is competent and able to deal with inquiries like this and push forward a bit quicker. I think that can have a massive impact. So the legals is where it always gets snarled up. So getting a good solicitor is almost the equivalent of getting a fast track option. Then the next one is, if the valuation comes back lower than expected, how will you assist? So the first one, I mean, there's really only two things we can do. One is go to another lender and instruct another valuation. The second one is that we can appeal the valuation. So if, for example, there is something fundamentally incorrect within the valuation, we can appeal it. If they've used the wrong comparables, if the maths just doesn't quite add up, again, we can try and appeal it. But I would say realistically, your best chance of success is to move lender and instruct another valuation. And then it says, what happens if my application is declined? Can you find alternative solutions? Absolutely. Like I said, in 8 years or 6 years, I don't think we've ever had a client that we haven't been able to finance in one way or another. What I would caveat that with is there is always a cost to that finance. So depending on the reason why it was declined, there will be a lender that will help you, but it will come at a cost. And it's just whether the deal can cope with that cost. And then the last couple of questions are, will you provide ongoing advice for refinancing or expanding my HMO portfolio? Absolutely. I think what a lot of people don't realize is that we get involved very heavily day one on a lot of the development stuff that we do. We also get quite heavily involved in the back end as well, in terms of clients who kind of want that consultancy side. So if you want advice around kind of strategy and implementation and growing and sort of the best methods of growth, we'll get quite heavily involved in that if we need to. So it's not just limited to HMO portfolios. We've helped clients expand their portfolio of single lets. We've helped clients to expand their portfolio of developments that they're doing. So we really do try and get involved in every facet that we can. And then the last question is, can you help me review my options periodically? Absolutely. That is literally the job of a broker, is to sit there and periodically assist you in either refinancing the whole portfolio or just refinancing bits that need doing. So we will often run entire portfolio reviews for clients. We'll often go through and sort of check, right, okay, is this the most cost-effective finance for this bit? Could you raise some equity here and invest it elsewhere? So it's all kind of part of that consultancy side of things. Hopefully that was helpful. We have done a number of these AI interviews now. I really enjoy them because it's almost like I'm getting interviewed, which I quite enjoy. Hopefully you enjoy it as well, because actually it's just packed full of information and seems to be almost like a frequently asked questions series, just all in one go about specific subjects. So hopefully that one was helpful. We've now done one on development, HMOs, bridging, all of the process and everything else. So if there's anything else that you want to hear in terms of these kind of interviews, if you're enjoying them, let me know. The feedback that we've had, like I said, has been great so far. And a lot of these have been guided by people coming back to us and kind of saying, oh, can you do that? Can you do this? So yeah, by all means, drop me a message. Let me know if there's anything else that you want to hear. Otherwise, that leaves me to say thank you very much for listening. Catch you on the next one.